What is up, everybody, and welcome back to the Fresh Finance Podcast. My name is Thomas Elms. I have my co-host here, Kyle Ryan, as always. And today we've got another guest, Jake Catsby, who's going to help talk us through health insurance plans. He's a broker with Apollo Insurance in the Lee Summit, Missouri area. Jake, super excited to have you on. And today we're really just going to dive into kind of everything health insurance wise. I feel like this is something where everybody's got it, but nobody really knows what the heck is going on. And so we kind of wanted to have Jake on to walk us through from plan options to what are deductibles, what is an out-of-pocket maximum, what happens if co-insurance is required. We wanted to talk about business owners and how they can possibly kind of start creating a plan for how they want to deal with health insurance coverage with their employees. And then we kind of wanted to talk HSAs as well. So Kyle, would love to just kind of get your initial thoughts on health insurance, this conversation, and what you're looking forward to today.
I love how you open that. It's something everyone has, but it's something not a lot of people know about. And we all have it. A lot of people are required to have it. And it's one of those things that it's okay. You know, it's one thing to not know how it works. It's perfectly okay. That's what we're here to explain today. But you will know the consequences of being underinsured or having the wrong sort of policy on you. And that'll typically happen when it's too late. So what we want to do today is make sure we are as educational as possible to help people understand their health insurance policies.
Absolutely. And Jake, to kind of get started here, I'd love to have you just kind of walk through what I would say is kind of like the ground floor of health insurance education, is kind of the types of health insurance coverage options that are available. And, because I know we talked about a little bit about this offline, but just kind of walk us through what's kind of available on the marketplace today.
Well, the common conception is the only thing that is available is the marketplace.
Yeah.
So that's the Affordable Care Act. You know, some might know it as Obamacare, Marketplace, Affordable Care Act. Essentially, the marketplace, in a lot of eyes, is the way of the land. It's the only thing legally classified as health insurance, which on the individual market, that is definitely a fact. But outside of that, you know, from a broader perspective, there are a lot of options that don't go through the Affordable Care Act rules and regulations. So we'll kind of get into that. But I want to kind of lay the parameters of really what the marketplace looks at. It's going to look at, you know, your age, your income, zip code, independence. So depending on those factors, you know, policies can be extremely cheap. You know, some people can qualify for plans as cheap as $0, or some people can pay for plans that are, you know, more full price. So every state's different. You know, some states are going to be state exchanges. Pennsylvania, New York, New Jersey, California are primarily a lot of the state exchanges. They work a little bit differently than the marketplace does. But ultimately, all the plans are the same. The rules and regulations that the marketplace has in place are for pre-existing conditions. The marketplace essentially mandates that any and all pre-existing conditions must be covered, and carriers cannot underwrite or change prices based off of that. So that's ultimately the biggest thing. The other big thing is there's preventative coverage. Preventative services are covered, you know, 100% of these policies, which for a lot of people, the marketplace really does help out. But any questions on any of that? I'm kind of
no, that's good. And great. For Kyle being in Philly, I'd love to have you kind of dive into what you were talking about surrounding the marketplace there. But I forgot to say this in the intro, and I told myself I would, but I didn't. Kyle, I know you're writing it down, but we're having Jake on for educational purposes. This isn't an endorsement for his services. Back to you, Jake. Would love to hear you kind of walk back through that.
Yeah, ultimately, so like, for example, state exchanges have their own systems that they enroll through during the year. So the crazy thing about how individual insurance works is you have to have what's called a qualifying life event to be eligible for an enrollment. In a lot of states, those are definitely still mandated, and they actually, in every state, they're still mandated. Those qualifying life events are going to be, you know, loss of coverage via an employer, or maybe a spouse, or maybe a child turns 26, so aging off a policy. That is proof of loss of coverage. Change in household size, so becoming married or possibly becoming divorced, that is also a qualifying life event. And then ultimately, like moving from zip code to zip code is also one. All of these things are going to be required for individual sakes to provide documentation for that, for an enrollment. Otherwise, without having qualifying life event, technically speaking, for individual purposes, you're not eligible through the marketplace to obtain coverage. Does that make
Got it.
sense?
So,
Yeah.
and
How does
that's
that interact?
interesting. Go ahead, Kyle.
How does that interact with open enrollment? Just because I am a novice here.
Yeah, so open enrollment well, there's a couple things. Your company can have an open enrollment, which is typically runs on some companies do it nice and they keep it around the same time as like the individual open enrollment. You know, for us, that might be very beneficial, but some kind of have it in the middle of the year. So that works differently for every single person. But ultimately, open enrollment for individual is November 1st through January 15th. It used to be December 15th until recently when they pushed it out just to allow more individuals to obtain coverage. Very beneficial for all because, you know, if you're like me, sometimes you typically wait till the last possible minute to something squared away. And so
Yeah.
it definitely did help out for sure. But Pennsylvania, their system, it's still federally regulated. Basically, you just enroll through, they call it Penny is their website name, but the state is it's regulated by the federal exchange. So the benefits of the policies, the max amount of pockets of the policies are all pretty much identical.
Got
I just went through that process. That is fascinating. I had no idea what it was. Figured everyone did it, but I literally used that website. I was like, all right, cool. Guess I'm all set.
There you go.
I think it's interesting too. You were talking about how a change in residence it can vary even from zip code to zip code, not from state to state. I think that's
Correct.
interesting too.
Yeah, you have to obviously move. Can't
Yeah.
just move in, but provide formal documentation. The reason that is a qualifying life event is because a lot of plans that are available in one zip code, if you move a zip code over, typically aren't available. The same plan might not exist. And the other issue is possibly the network might be slightly different than maybe the one that you were living in, you know, rural versus urban. It can definitely change what's available to you.
Okay. Got it. And, go ahead, Kyle.
I'm sorry, I don't want to get ahead of anything, but like say, you know, I have a client who moves from PA to Florida. Like it's clearly a case where that's qualifying life event. It's time to review your health insurance to see what's available in this state versus this state because they're completely different regulations.
Exactly. And that'll kind of open it up to some of my other points is like there are other options as well outside the Affordable Care Act. Obviously, having the qualifying life is the most important aspect. But like, for example, the plans that are available in Pennsylvania are different from the plans that are available in Florida. Whether that's term length on short-term policies, whether that's certain policies available versus not available. So yeah, I mean, it is definitely important to always kind of, you know, review your options rather than just sticking with what you got because it's, you know, convenient or easy. And, you know, maybe that plan might not actually be a good fit in the long run.
Convenience is king until it costs you money.
I love that. I've never heard you say that. Why are you holding stuff back, man? That was a good.
Sometimes I guarantee if you ask me in 5 minutes, I'm not going to remember what I said. So someone write that down.
Yeah. We need to clip that. And so kind of moving into that transition. So, you know, I know we kind of talked about more of the private market and also kind of the community and group-based markets. Can you kind of walk us through those as well?
Yeah, some of the options not on the exchange, right? Yeah, so that's going to be where it gets a lot interesting. And so essentially, when the Affordable Care Act came into place, any policy that doesn't officially go through the Affordable Care Act rules and regulations, being the marketplace, cannot legally classify themselves as health insurance, which is extremely important to note because there are other options out there. They're considered some different names, but at the end of the day, I think the best saying is kind of cheesy, but it barks like a dog, it talks like a dog, but you got to call it a cat. Still going to cover you the same way as your traditional insurance policy will, but ultimately, since it's not through the Affordable Care Act, it's not considered health insurance in the eyes of the marketplace or the government.
Okay, got it.
So to kind of go into that, some of the options that are out there, there are going to be short-term medical policies. Short-term medical policies work a little bit different. They're going to look at your age, your zip code, and then they're going to look at health. The biggest driving factor in these policies is really age. Somebody that might be using a little bit less insurance coverage, or maybe is looking more for a high deductible plan, more of a catastrophic policy. These options can be a great fit. We're going to talk about the term networks and stuff, but biggest thing is short-term medical plans run on PPO networks. So similar to a group policy, you're not necessarily going to have to sacrifice the benefits of the network going one of these routes. Make sense?
Yeah.
The other options, there's going to be we call them some private PPOs or healthcare sharing ministries. These policies are going to be more robust. They have a little bit more bells and whistles per se, whether that be copays for the doctor, better preventative coverage, copays for prescriptions, you name it. They're typically similar to like a silver or more of a gold style on a group basis policy. Big things with, these policies is there's a lot of different ones out there. The biggest thing that, I like to think of is insurance at the end of the day should be easy. It should work the right way. And at the end of the day, we all carry insurance for one big reason, and it is to protect us from a catastrophic event instead of having to worry about paying $1 million bill or $500,000 bill, because that's your livelihood, right? You work every day, and what's going to protect you? It better be your insurance,
Yeah. Well, and everything medical is just crazy expensive nowadays. I mean, if you want to go get an MRI without health insurance, it's, you're going to have to, sell your house basically. That's a total exaggeration. I don't know what the current costs on MRIs are, but I know they're expensive. And the ministry side is interesting too, because I have met a lot of people that have a specific religious orientation that will apply their health insurance to that type of a community, and it's almost kind of like a group paid plan. Would that kind of like be an adequate description of that? We don't have to go into too many details, but
there's a number of different ones out there. Some of them, do have their own faith-based backing. Some of them are more so you just have to believe in a certain, basically their foundations of belief, promote positive life, be generous. There's some out there that are definitely faith-based. There are some out there that are not. The biggest thing that's important to note with healthcare sharing ministry plans is a lot of them work a lot differently. Some are more reimbursement style. Some are more non-traditional, which basically means you do have more copays per se. So I go into the doctor, I have a $25 copay, and that's what I'll be paying versus, a reimbursement. Maybe I'm paying 25 and then I have to pay and then get reimbursed in the back end. So there are a number of different ones out there. Some work very, very well. Some of them, to be very transparent, I wouldn't always recommend. The biggest thing with any insurance is just to make sure you're very well educated on it. How does it work? What are the exclusions and limitations? What's going to happen in the event of this? And just crossing your I's and dotting your T's at the end of the day. Because as we talked about, you're protecting your investments, you're protecting everything that you basically built up to with your insurance. And so I think the best piece of advice that I can give, for anybody is really truly dig deep into how the policy actually operates and give yourself the benefit of the doubt of that ahead of time, rather than on the back end, going to the doctor, using it and not necessarily understanding, hey, how's this going to work? I think the best example is my father, bless his heart, but we went to the doctor and ends up getting a bill, and the plan worked the right way, but ultimately because he assumed that it was going to work a different way, he was frustrated with it at the end of the day. But I was like, hey, here's this X, Y, and B, but it's because we don't evaluate, and it's not necessarily our number one concern always, but education.
Yeah. And to kind of like go into, like, I would say maybe like a two-step of, evaluating a policy. One of the things that I have had the most conversations about, even as an advisor, when kind of at least evaluating what somebody's health insurance plan looks like. And when I'm doing that is normally during like a review of their company benefits, as we're just kind of walking through everything that the company provides. And, health insurance for most people is going to be on that list, is looking at monthly premiums, looking at the deductible that they have to meet before the insurance starts really kicking in. And then the out-of-pocket maximum and co-insurance. Can you kind of like walk through the terminology and like why those things are important to recognize and understand?
Yeah, no, I'll start with, and I know we've talked about this, like every situation is different.
Yeah.
One person who goes to the doctor maybe once every 2 years might be comfortable with having a higher deductible, higher max out of pocket. Somebody that might have a little bit more usage, or maybe they have a higher prescription, depending on the policy, might need a lower deductible. But I think to give you the definition of a deductible is essentially the amount you would pay prior to essentially the healthcare services being essentially covered by your insurance.
Yeah.
So we kind of look at it in a couple different ways. You have your deductible, you have your max out of pocket, and in between those sprinkled in is your co-insurance. Biggest thing is, if I could give you an example, is $100,000 medical bill. Let's say my deductible is $5,000, but my max out of pocket is $7,000. So ultimately, I'm going to have to pay my $5,000 deductible, but sprinkled in there is that coinsurance, the nice fancy number. Everybody loves a 90-10 policy or an 80-20. Some might be 60-40, or you might even see 50-50. But that number right there is essentially the difference. So that $100,000 bill, a doctor, let's say it's 50-50 coinsurance, insurance carriers paying 50%, you're paying 50% up to that additional maximum out of pocket.
Yeah. So essentially the $2,000 difference you're paying, and let's say you're doing the 50-50, is you're taking 1,000 of that, the insurance is taking the other 1,000, and then the insurance covers the rest after that.
Yeah, essentially, once you hit your maximum out of pocket, you're covered 100% for the remainder of that year. Some plans, and this is another thing that's important, operate on a calendar year. Some plans operate on a program year. So that is definitely something that you need to know, kind of, especially when reevaluating your policy.
Yeah. And the difference clear. There's the simple difference between a calendar year and a program year. Calendar year starts 1/1. Program year could be June 6th or something like that, and it just carries through to June 6th, like an anniversary date.
100%.
Perfect.
Actually,
Okay.
All right, I didn't realize that.
And, so those things are super important. Now, kind of transitioning from the individual side more over to the business side, the business owner side, and kind of focusing, I would say, on, businesses anywhere from a solo business owner, running something on their own to, up to maybe 50 employees. Can you kind of talk through your thoughts on kind of just the health insurance situation there in general, right? Whether, you're evaluating possibly getting your own group policy, maybe looking at doing something different. Can you kind of talk us through some of the conversations that you have with people in that situation, kind of how you navigate that?
Yeah, it's a tricky situation, to be honest, because the common conception is once you own a company, the common conception is as a small business owner, you need to pay for insurance.
Yeah.
And I think that's the hardest part, especially as a business owner. Like, it puts you in a spot where, you want to provide quality benefits. You want to keep your employees happy. You want to offer benefits that keep your employees there ultimately. And so it's like, it's kind of tough to weigh ultimately, but, realistically to start off is obviously you have to have two people to, have a group policy in general. You can't really do it with just one, but the whole 50 employees, once you hit 50 employees, you're legally obligated to offer what's called MEC, or minimal essential coverage, to each employee. And again, that's 50 full-time equivalent employees. So if you have, 45 full-time employees, technically speaking, that's not MEC, so you're not legally forced to provide MEC coverage to them. Now there's MEC plans, there's MVP plans, there's a whole bunch of different options out there. I don't want to get too off on a tangent there, but realistically, for small business owners and group plans, it is tough. I like to say once you get to 10 employees, then it does start to make a little bit more sense off of cost-wise for the company to offer a group plan. But really, under 10 employees, most employers would probably save half their premiums, if not more than that, if they did individual policies rather than doing a group plan.
Yeah. Yeah. And something that we kind of talked about offline is, a lot of business owners will go the health insurance route, providing health insurance as some sort of incentive to try and create an opportunity to bring in the best possible employees that they can. And, one of the things that we kind of talked through is, a good possible strategy. This isn't a specific recommendation, but we were kind of hinting at the idea of if you have 10 employees or less and you want to go the individual route, having those employees get their own, personal insurance, and then providing possibly like a stipend to cover that insurance, where you're kind of still hitting the objective that you're trying to get, which is to attract and retain high quality employees by providing some sort of health insurance coverage. But in a way, you're almost doing it where, in my opinion, it's more portable for the employee if they were to leave, right? But also, you're lowering your out-of-pocket cost as the business owner, while still providing the same benefit.
You're still getting a tax deduction too.
Yeah.
Yeah, you guys are spot on. And I think I think the other really positive aspect, if you go about it the right way, right? There's a right way to go about, let's just say, for example, we have 8 employees. There's a right way and there's a wrong way. And when I say that is, offering quality benefits, if you were to just go to one specific carrier, they're really probably going to only have one or two options. Individual plans, because they are so regulated, right? They have to offer these benefits, whether that's Affordable Care Act plans, or maybe some carriers in certain states will give you a short-term option. But as we talked about, like, short-term options might not be a great fit for everybody. And so I think the biggest benefit, and kind of where I kind of can stand in, or other brokerages as well, is like not having just one specific option, and then truly knowing whenever your employees are reaching out to somebody, one, they're getting the same person every time. So they're getting repeatable answers. And also there's somebody that is a direct point of contact for you as the employer, right? Rather than just sending it off to a Blue Cross and saying, hey, I'm going to give you, X amount of dollars. Let's just say I gave you $200 a month for insurance, not necessarily fully knowing if the employee is actually paying for insurance.
Yeah.
There's kind of a common ground and less risk necessarily on the actual employer, because they have somebody who is truly on their side, who wants what's best for the company at the end of the day, as well as the employees. And it's kind of a full circle working in the same direction towards a common goal, essentially.
Yeah.
Now, I would imagine anything with a group plan versus getting individual policies for each person, it's of course going to matter on the unique circumstances of each of your employees as business owner, right? Because say you got 6 employees and they're all, obese with cancer or something. It might be better to get a group plan because they don't look at that sort of stuff. They don't look at your health. Whereas an individual policy, good luck. Is that fair to say?
Yeah, and then so to kind of go in that, there's fully insured policies on group plans, and there's also what's called like level insured policies. The biggest thing is fully insured policies. They are going to be fully guaranteed products. They're not going to change their rate specifically off of one person's health. But then again, fully insured products typically can be a little bit more expensive. Level insured policies, how a level insured or self-insured plan works is they do work a lot different. A certain amount or a percentage of the employer's monthly premiums goes into a pool or a pot of money. And let's just say the company as a whole has a very healthy year. A percentage of that out of that claims account would actually get reimbursed for the employer to use maybe next year's premiums, or essentially towards the company. So there are some different options for group plans, but again, like we talked about with, the Affordable Care Act, there are options that are fully insured that if somebody is currently undergoing, gosh forbid, a cancer, they would have a policy that would cover them for that.
Interesting. See, and there's like 15 variables that we just talked through that I'm sure, probably 70 to 80% of business owners haven't even contemplated yet. And, I can tell you there's probably 10 business owners from a rock's throw away, that probably haven't thought about, if I have 10 employees or less, maybe I should consider just maybe taking a different lens to providing that type of a benefit, whether it be group or individual. I think that's super important. And, the last thing that we wanted to cover was the HSA conversation. The question that I wanted to ask you is, do you see HSAs opened up often? I'm trying to find like the right terminology to use here, because I feel like once I've actually dived into like the specifics of what is required to get an HSA, I feel like a lot of people probably don't know that, and then therefore don't actually set one up. Do you guys actually deal with like setting up HSAs, or is that kind of something that the plan participant has to go out and do themselves?
Yeah, the plan participant would do that on their own. We do not set up HSA accounts. I think the most common time we see people come with HSAs is maybe somebody that comes from a group plan or a previous employer policy that has always had an HSA account and still actively wants to contribute. That is definitely the most common time we see them.
Yeah. Because the reality on the HSA is, and they call it the golden tax account to a degree, because when you have an HSA now, again, you need to have what's called a high deductible health plan in order to qualify, which for 2023, and they're always changing these numbers, your deductible needs to be at least $1,500 if you have an individual plan, or $3,000 if it's a family plan. And it allows you to save for additional medical expenses, but also invest the money at the same time. And so to kind of talk through this, the contributions that you put towards this account are tax deductible. So that's really great. Now there's certain stipulations around that, but they're tax deductible. You can also invest the money in a tax deferred status, and then you can actually distribute the money towards qualified medical expenses tax free. So once the money comes into the account, you never have to worry about taxes and you get the deduction up front. There's not an account out there that's like it.
As long as you use it for, qualified medical expenses. But yeah, I mean, like, you put money into a 401k, yeah, I get a traditional IRA, 401k, what have you. I get the deduction up front, but I got to pay the piper on the back end. This account is the only thing like it out there. Deduction up front, nothing as you go, and it's tax-free on the back end. It's very unique. I love using these.
Yeah. And,
right people.
and here's,
you have to have the right people. You have to have the right health plan, of course.
yeah. And here's where I really like it is, and I was just reviewing this an hour ago for a client, is long-term care coverage. You don't want to buy long-term care insurance too early because then you're going to be paying premiums forever. But when you do need it, it's normally so freaking expensive. And the way that I look at an HSA is this can be a way where you can save for retirement medical expenses that's tax free and never have to worry about long-term care coverage. And for me, I just feel like also it provides a lot of flexibility because yes, you can also use it for medical expenses if need be, while you're still working, but at the same time, you can take that money out in retirement for non-qualified medical expenses, and you almost just treat it like an IRA distribution. It's taxable as income. There's no 10% penalty if you're taking the money out in retirement. But there's just so much flexibility that you can provide for there. The last thing I did want to make a note on, and I saw this the other day, is from an estate planning perspective, an HSA is kind of a nightmare. This is the one thing that you do want to kind of just make yourself aware of. Now, most people don't run into this situation, but if you still have money in an HSA and you pass away, if you have a surviving spouse, they inherit that HSA as their own. That's nice. But if that spouse passes away, and let's say it goes to one of your surviving children, all of the remaining balance is taxed as ordinary income right away. So you have to liquidate the account, and it's all taxed as ordinary income in that year. Yeah. So that's kind of like, I would say, the one caveat to HSAs. But at the same time, the reality of somebody not using all of their HSA funds, because I feel like I'd like to find this out, but what the average HSA balance is, it's probably pretty low. But just the greatness of this account, if you use it correctly, is incredible.
Yeah, and you can't use it once you qualify for Medicare, so age 65 plus, you can't contribute to it anymore. And one of the other things I see a pitfall of these is people use them too early.
Yeah.
So say I have an HSA. Let's say in 10 years, I've got a medical event. I've got to come up with money out of pocket. I can use my HSA, or I can come up with money in the bank account. Well, the money in the bank account is earning whatever it earns in interest. The HSA, I can grow tax-free for another 20 years and then use it on when I have increased medical costs because of inflation, probably more expensive medical costs because I'm older. Like I see it happen quite often where people use it just whenever they can, right? As soon as they hit their deductible. All right, whatever's next, HSA. Be wary of that.
Yeah. And I think that's where aligning yourself with somebody like Jake could be beneficial, is recognizing like what you can afford from either a deductible perspective versus an out-of-pocket, well, actually, let me back up. Sorry. From a monthly premium perspective versus a deductible and out-of-pocket maximum is trying to figure out what plan fits you the best. Because I totally agree. And one of the caveats on the investment side is normally, depending on the custodian that you utilize for your HSA, and you can normally set it up about anywhere where they're an investment custodian, is there's normally a minimum cash balance that you have to have at all times. And then the rest you can invest, and you can invest it essentially like any other account. Now, I don't think you can do like individual stocks or anything. It's normally got to be ETFs or mutual funds, but
I could be wrong, but I think you can do options trading in HSAs, but I hope
Oh,
I
that's
think I've seen that in the past. It shouldn't be allowed, but I think I've
yeah.
seen.
Don't do that. Don't do that.
Don't do that.
But yeah, that's kind of the kicker on the HSAs. Jake, do you have anything else kind of on that front?
Yeah, I mean, ultimately, and obviously you guys would know more about this, but a lot of bankruptcies for a lot of people, typically the number one cause is medical bills. So, going back to health insurance premiums and deductibles, max out of pockets, obviously for an HSA, you have to have a compatible policy, whether that's a group plan, whether that's a marketplace plan or a short-term medical, whatever it may be, it does have to be compatible. And you guys would know this more, but it comes down to what are you comfortable with? At the end of the day, it's like, hey, you'll have your deductible, you'll have your max out of pocket. Those are real numbers. Those are not just numbers on a piece of paper or on your insurance card that look all fancy. That is real life. And so what at the end of the day is something that you're comfortable with. And, I don't want to go off on a tangent away from the HSA, but, there are some things that you have to essentially mitigate some of that risk, whether that's an ancillary product or some sort of supplemental. The biggest thing is they do protect you from out-of-pocket exposure, whether that be an accident portion of your insurance, whether that be a critical illness. I think I got a couple examples just in my experience here.
Yeah.
I have a client whose income was $20,000. Okay. She had a gap policy on her plan that was $50,000. She's been a client for close to 2.5 years now. I got a call last open enrollment sometime in November, and this is a very true example. She was diagnosed with cancer. And so 2.5 years ago, we had purchased a policy. It's called like a cancer, heart attack, and stroke. So in the event that a first-time diagnosis, has she ever been diagnosed with something like that, she would receive a lump sum payout for the benefit amount. So you have this individual who makes $20,000, who just finds out that she has cancer, she can't work, she can't live her life because all of a sudden she has this life-changing event. Now she didn't know, well, she didn't probably really remember that she was paying for a gap policy that was $22 extra a month for the last 2 years. And so essentially when I called her back after the case, I said, hey, I'm not going to say her name, but how would you got a check for $50,000? What would that do for you? And for a lot of things, and I talk about gap policies, and they do work, and I am passionate about them because essentially they are life-changing things. The issue is paying the extra monthly premium, right? It's having the extra coverage for something maybe as a 25-year-old, I'm a 25-year-old, I might not necessarily see that much value in, but at the end of the day, it's like when I'm 50 or when I'm 60, do I really want to pay or have a medical bill or a max out of pocket of $10,000 and have to worry about that?
Yeah. Yeah. No, I think that's a great point. And real life examples they always just hit the nail on the head. Geez, like that's just crazy to me. I'm sure that was probably like the call of her lifetime.
Yeah, there were some emotions involved, and I think insurance in any ways, it's not a glamorous subject, right? It's
a transfer of risk, right? And I think that kind of like nails what you were talking about earlier, that it's kind of weighing that that possibility of risk versus the premium that you have to pay, right? And that's just kind of even like where we need to walk through from a life insurance perspective, from a home insurance, car insurance, umbrella insurance, health insurance, whatever it may be. It's all a transfer of risk. And whether you are willing to either self-fund that out of pocket, or whether you are willing to pay premiums on a period of time basis to transfer that risk to some sort of insurance carrier. I think just starting to recognize and understand when and where you should be transferring risk to, it makes a lot of sense and it's important.
Yeah, spot on.
Perfect. Well, that's all we have for today. Do either of you have anything else?
You got confused at any point during this, reach out to someone like Jake. They will help you out. If you didn't get confused, congrats, you're probably in the industry.
There you go. I love it. I love it. Awesome. Well, thank you to everybody for watching and listening. Jake, thanks for coming on the podcast today. Really appreciate it. And we will see you guys next week.
Thank you, Thomas. Thanks, Kyle.
Thanks.